I'm Justin Simpson, head of the Quantitative and Structured Solutions team at Morgan Stanley Investment Management. Today I'd like to introduce you to a compelling opportunity: exposure to the commodities asset class via one of the few actively managed funds available on the market. Commodities markets are among the oldest in the world. It is only in recent years, however, that commodities have gained popularity as an investment vehicle for institutions and individuals. Several factors are driving this growing interest, including a positive secular outlook for commodities prices and the diversification benefits gained by including commodities in a portfolio. In addition, commodities prices exhibit inefficiencies that we believe can be systematically exploited to generate additional return. Let's touch briefly on each of these points. In recent years, commodities prices have risen significantly due to strong demand outweighing supply. We believe the factors behind this imbalance are likely to persist in coming years. On the demand side, unprecedented growth and rising standards of living in emerging market countries have created a tidal wave of new consumers, resulting in increased demand for raw materials, agricultural commodities, and luxury items. We believe this demand is structural and likely to persist throughout the economic cycle. The supply of commodities has not kept pace with this growing demand. That's because extraction and processing new sources of commodities takes a long time, as long as 20 years to bring a new commodity oil reserve into production, for example. This long lead time means supply constraints could persist for years to come. Historically, commodities have also been one of the few asset classes to benefit during periods of higher inflation, particularly unexpected inflation. They've also been more resilient during periods of geopolitical uncertainty and macroeconomic shocks. Due in part to their ability to hedge against inflation, commodities is one of the few asset classes that historically have had low correlation to both equities and fixed income. This, combined with the potential for attractive longer-term returns, means even a modest allocation to commodities has the potential to improve a portfolio's risk-return profile. Investing in commodities is not without risk. That's why it takes disciplined investment management to invest in this complex market. At Morgan Stanley Investment Management, we believe exploiting market inefficiencies in pricing can create additional return potential that is uncorrelated with the commodities market as a whole. To tap these opportunities, we rely on an active, multi-strategy investment process, one that utilizes rigorous quantitative models to construct positions and manage risk. We start by providing efficient access to potential commodities market returns via investments in derivatives and fixed income securities, including money market instruments. We then overlay our actively managed alpha strategies that seek to generate incremental return above the market. Our alpha strategies are designed to exploit market inefficiencies systematically. For example, one strategy seeks to take advantage of the slope of commodities futures curves, allowing us the potential to capture any returns earned by rolling a position from an expiring contract into another contract along the curve. Our Quantitative and Structured Solutions team brings extensive investment experience and manages active commodities portfolios for investors around the globe. The team is able to leverage the broader resources of Morgan Stanley, one of the premier global commodities franchises, which underscores our ability to provide investors entree into this fast-moving market. With Morgan Stanley Investment Management's Commodities Fund, you now have an innovative solution designed to help your clients diversify risk and generate potential returns, all within an actively managed, risk-controlled framework.